regular viewers know that I love breakups. Because when a big company divides itself into smaller, more easily managed outfits, these bite-sized businesses typically do better, and Wall Street laps them up. This week, we got not one, but two major breakups, with GE spinning off its power business as an independent company. I told you I like that very much. And then 3M doing the same thing with its healthcare division, and I haven't talked enough about it. So tonight, I want to give you a deep dive in these moves, okay, because it really does matter. I'm going to start with 3M's healthcare business, which began regular way trading, was Solventum today, okay? Now, we know 3M's had a tough time for many years now, with the stock steadily falling, in part because of major litigation. They've been eaten alive by Forever Chemicals and faulty hearing aid lawsuits, the latter being from combat veterans, very sympathetic plaintiffs. Meanwhile, most of the businesses have slowed since 2018. 3M's peaked then. It's been a tough road, okay? But that's not the case for 3M's healthcare unit, which has grown steadily over the past 5 years. In fact, Solventum hasn't had a single year of negative organic revenue growth for the past decade. So the healthcare spinoff was all about freeing this terrific business from litigation-induced melees at the rest of the company. So what do you get with this Solventum? All right, this is a business that did $8.2 billion in revenue last year, split across 4 segments. More than half of its sales came from wound care and surgical solutions last year. Think everything from medical tape to advanced patient monitoring equipment. The rest of the business is split across dental solutions, health information systems, and purification and filtration. These are all high-growth businesses. Management says each of these end markets can grow at a mid to high single-digit clip going forward. I believe them. Lots of money in these aspects of the healthcare, thanks to their aging population, plays right in their wheelhouse. At the same time, Solventum is plenty profitable. I'm telling you, this is interesting. As 3M margins have slid steadily lower for years, the margins of Solventum have held up just fine. Of course, they're going to take a small short-term earnings hit from consolidated costs that come with the breakup, which is typical. There are some additional complications here, though. See, the plan is for Solventum to gradually go from a 3M-affiliated business to a customer that's licensed as 3M's intellectual property. The parent company isn't just handing over its IP as part of the spinoff. Now, this is not ideal. Solventum frames the split from 3M as an opportunity, quote, reposition for growth, with a goal of getting its own growth rate in line with the growth of its end markets. Right now, it's lagging the industry. That's an opportunity. They'll look at their portfolio, choose which end markets to exit, which ones to invest further in, and they'll invest more into research and development than they could when they were part of 3M. I like that. Meanwhile, Solventum also plans to look for places to cut costs, and they've said they're going to prioritize paying down debt over the first 24 months after the spinoff. I like that, too. I like a clean balance sheet. By the way, as part of the breakup, Solventum's taking on some additional debt in order to pay a dividend to 3M on its way out the door. That's not unusual. Even with that, I think the balance sheet's okay. Not ideal, but it's what happens, okay? Now, we don't even know if Solventum wants to return cash to shareholders via dividend or a buyback, but given the prioritization of debt repayment, I don't expect much on that front for a couple of years. That's a negative. Finally, 3M is only spinning off 80% of Solventum stock to its existing shareholders. They're planning to hold on to a 20% stake, which they want to gradually sell down over the next 5 years. That's a real long-term headwind if you want to own this one. Putting it all together, I more or less like Solventum's core business, but this is not the cleanest of stories, and their guidance for this year makes it clear that 2024 will be a rebuilding year for this newly independent company. Maybe people don't have the patience for that. The good news here, though, is the stock seems super cheap. Solventum traded down to around $69 today, the stock's first day of regular way trading. Given their full-year earnings forecast, that means the stock's only selling for roughly 11 times this year's earnings. That's cheap. By comparison, a company we like very much, Becton Dickinson, it is a similar play in the medical supply space, trades at 19 times this year's earnings estimate. Now, Becton Dickinson does deserve a premium because it has better numbers, but maybe not that much of a premium. However, while I can justify buying Solventum at these levels, you should keep in mind that many of these spinoffs tend to have a rough time in their first few months. Many people who get shares in the spinoff simply don't want them, and they gradually get shaken out over time. Maybe you're in 3M because you like 3M, you don't want a healthcare business. Now, we have seen this happen many times. Look, the old Kellogg. They spun up their cereal business. It's a pretty good business. WK Kellogg, stock initially went from 15 to 10 for only rebounding to nearly 20% as of today. That's good. Danaher, how about this one? They spun off its water business for Veralto. We like that as part of the investing club. Stock initially tumbled, though, from the mid-80s to the mid-60s, but then it climbed all the way back to the high 80s. That's pretty amazing. So if you're inclined to buy Solventum, I recommend buying it gradually over the next 6 months because you'll likely get a better price than you get right now. But what about the former patient? 3M. Well, it's actually more of a parent. All right, now get this. This one's really tricky. And it's one that, like, my dad used to work for 3M, so I'm very sensitive to this. It's one of the greatest stocks, and I always wanted Pop's company to work. I haven't recommended 3M in a very, very long time because I hate playing litigation roulette. People who follow the club know this. But this spinoff of Solventum is part of a broader simplification of cleanup of an effort by the outgoing CEO, Mike Roman. It's a really smart one. Plus, 3M reached some major settlements on both big lawsuits last year, agreeing to pay more than $10 billion to settle the Forever Chemical claims, another $6 billion to settle the faulty earplug lawsuits. Now, that doesn't necessarily mean that these issues can be put to bed, but I think the vast bulk of the damage has been contained, albeit at pretty high cost. Now, if you buy 3M here, you are betting the company can turn things around and they're cost-cutting like crazy. More importantly, you're betting that new management can right the ship. This stock rallied more than 10% a couple of days last month after CEO Mike Roman announced he'd be stepping down, transitioning to executive chairman. Now, clearly, Wall Street likes the 3M's bringing in a new leader. They're bringing in this guy, Bill Brown. Now, he did a fantastic job when he was running L3Harris Technologies, one of the better defense contractors. We've been huge backers of Bill. He's a no-nonsense industrial veteran. I think he's a great choice. I'm still hesitant to give it a full throttle endorsement, but I am so close. So right now I feel better about this company's prospects than I have in so many years. I sure wouldn't stand your way if you want to start buying at some of this stock. That's right. I'm saying you can buy 3M right here. Let me give you the bottom line, though. This is really important. The 3M breakup is finally complete with Solventum shares trading regular way. While Solventum has a good but not great story, the stock fortunately has a darn cheap valuation. And you have my blessing to buy this one into weakness. Just remember that new spin-offs tend to be volatile for the first few months and go down. As for 3M, I know it's still risky. I know it is. But you know what? It hasn't been this attractive in years.
Buy, buy, buy! Buy, buy!
You heard it.
Buy, buy, buy!
Let's go to work. Randy in California. Randy.
Booyah, Cramer.
Booyah, Randy.
Hey, I bought Moderna prior to them perfecting the COVID vaccine. That was the good thing. Unfortunately, I rode it all the way up and all the way back down and didn't take any profit. I'm still up, but my question is, in light of some vaccines that they're potentially releasing, should I sell Moderna?
No, I think Stefan Bancel, we had him on, and actually I'll invite him back on again. I know he was on the network recently. I actually am a believer in the technology. I have been since I met him when the stock was at 16 at the JP Morgan conference, healthcare conference years ago. I want you to stay in it. And if anything, I'd be a buyer under 100. There, I really do believe in him and his technology. Let's go to Dan in Massachusetts, please. Dan.
Good afternoon, Jim. How are you?
I'm good, Dan. How are you?
Good. You do a terrific job. Thanks for taking my call. I appreciate it.
Thanks, partner. Appreciate it. How can I help?
Listen, Novo Nordisk, they got a couple good drugs in the pipeline now. They're doing very good, and they're a profitable company.
Yeah.
They got two more drugs coming down the road. Should I invest more in this company? What do you think?
Actually, look, I got to tell you, for the club, we own Lilly, and we are betting that later in the first half of this year, we're going to get approval of a very important Alzheimer's drug. In the interim, Lilly's Mounjaro is selling really, really well, and Zepbound selling really, really well. That's the one we want to be in. All right, now look, guys, this is a big recommendation for me. I was thinking about doing it for the club, but it's still a little early. The first one is Solventum. That's a darn cheap valuation. You got my blessing to buy that one into weakness. Just remember, new spin-offs tend to be volatile for the first months. And then the second one is 3M. And I like that. All right, much more Mad Money ahead. California is raising the minimum wage for fast food workers starting today. I'm sitting down with Chipotle's top brass to see how that move might impact the company's profit potential. And, by the way, we want to talk about a split. I'm highlighting one market sector also that should have surprised you. Wouldn't have surprised you, though, if you're focused on stocks and not the bond market. So let's see. We got Chipotle on the stock split. We got some interesting ideas about the buybacks and home builders. We got a lot on this show. And, of course, we got rapid fire tonight's edition of the Lightning Round. So stay with Cramer.